Hi everybody, it's Dave Aquino with Basecamp Trading, and normally when we coach traders at Basecamp, we come across a lot of questions that are repeated a lot that our traders have. So I just want to address one of the most frequent questions that we get, and some of our traders are asking us, what are market orders, limit orders, and stop orders? So I'm very happy to have the chance today to kind of talk about those three different kind of orders when we are trading. Now, the first thing we want to talk about so you can kind of understand how these orders came about. Let's just take, for example, the current price of Apple stock, AAPL, which is trading for about $305. Now, you can pretty much look up the price of Apple anywhere on your iPhone, on your brokerage's platform, and you'll see a number, 305. But actually, that number is the last traded price. The actual quotes, if you're looking to trade Apple, you're going to see one number called the ask. And if you were to buy it, that's where you would buy it at the market. So this is normally higher than the quoted price. So as I look now, the ask is 306 in our example. And then we have another lower range number we call the bid. And that is currently trading for 304. So you can see if you ask what the price of Apple is to a broker, he'll say the ask is 306, the bid is 304. So basically what that means is if you look to buy at the current market's request, so we call this a market order, okay? The market will be very happy to sell you a share of Apple for $306. Okay, now if you're looking to sell your Apple shares, the market is very happy to take your shares from you as you sell them, and they'll be happy to pay you as you sell it $304 for your shares. Okay, so you can see how this benefits the other party. And this is kind of that slippage that you have as a stock trader. You can, you'll have to pay a little bit more to get the shares than the quoted price, and you'll get a little bit less than the quoted price when you go to sell the shares. Now that is if you look to the market to go ahead and process that order for you. Now, if you go ahead and say, well, I want to have a little bit more control over the price that I get filled on, so I'm going to input a limit order. So what you're doing with a limit order, you are actually going to define the price yourself that you're willing to pay to accumulate the Apple shares. And you might say, look, I will pay $305 or less to take away those Apple shares from you, or I'm willing to get the minimum I'm willing to get when I sell these shares is $305. Okay, so you can define the price that you're willing to do a deal, but the flip side is the other aspect of that is you're not quite sure if anyone will take the opposite side. Okay, people might say, I'm not going to pay 305 because I really only want to play 304. Or I'm not going to accept your 305. I think I can find somebody to buy my shares from me for 306. So when you use a limit order, you're actually defining the price that you're willing to transact at. However, you're trading that off with the uncertainty of actually getting your transaction filled. If you're using a market order, because you're doing it on the terms of the market will fill you instantly. Okay? So that is a market order and a limit order. The third kind of order is what we call a stop. So let's go ahead and say you're willing to trade Apple, and you actually get filled for $305. So there's your $305 investment in Apple, and you believe Apple is going to move higher from there. Okay? Now you think to yourself, I could be wrong. If I'm wrong, how much pain or loss am I willing to take? And you say, well, I'm willing to lose $5 per share of my investment. So I'm willing to let Apple fluctuate down till about $300. If it goes below, if it hits $300 or below, I want out of the trade. So this is where we set the order that we call a stop loss order. Okay? So we set the price of your stop loss order at $300. So order sits out there, available to the market, basically monitoring the price of Apple. And once the price of Apple drops and touches 300, your position is immediately sold. Okay? So if prices go down 305, 304, 302, 301, it hits 300, you're sold out of the position and you have a minus $5 per share loss. Now, why would you do that? Well, if you were right on your guess as to what Apple stock may do, price would have gone up. But when you're a trader, you have to set that point at which you say, look, I must have been wrong. I'm going to go ahead and get out of this position before I lose any more money. And that's what you use a stop loss order for. Okay, so I hope this clarifies a couple of things for you. What is a market order? What is a limit order? And what is a stop loss order? Thank you very much.